Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 30th of January 2022, and over the weekend we have published our regular weekly update, and we've placed a link below. Now in that update we highlighted the fact that gold and silver prices had in fact fallen back, but equity markets picked up quite considerably on Friday. The main reason for the fall in precious metals to a large extent has been increasing yields and also the strengthening of the US dollar. The result emanating from the Fed's rather hawkish position announced on Wednesday. Since Wednesday, Goldman Sachs have come out saying they can foresee 5 potential interest rate increases in 2022. Now in our update, we've highlighted that whether we have 4 or 5 increases doesn't really matter. What matters is the level of those increases. It's been taken by most traders and for granted that such increases would be approximately 0.25% each. But in an article published by Bloomberg today, it highlights the fact that Atlanta Fed President Bostic says the Fed could do half-point March hike if needed. And we thought it therefore appropriate just to highlight this, because if other Fed governors or presidents come out with a similar approach, then we may very well see this send a shiver down equity markets and strengthen the US dollar even further. Let's just take a look at what's said. The Federal Reserve could opt to raise its benchmark rate by 50 basis points if a more aggressive approach to taming inflation is needed. Raphael Bostic, president of the Fed's Atlanta branch, told the Financial Times in an interview. Bostic stuck to his prediction that 3/4 point increases starting in March is the most likely scenario, though stubbornly high consumer prices may justify a more robust rate rise. The Fed typically increases rates in quarter-point increments. Quote, every option is on the table for every meeting. If the data say that things have evolved in a way that a 50 basis point move is required or be appropriate, then I'm going to lean into that. If moving in successive meetings makes sense, I'll be comfortable with that, Bostic told the newspaper. Bostic said he would be looking for whether higher wages are meaningfully boosting prices, though he expects wage growth to moderate in the coming months. Bostic is not a voting member of the policy-setting Federal Open Market Committee in 2022, so he won't actually have a vote of the FOMC, but is influential nevertheless. Fed Chairman Jerome Powell told reporters last week that officials were ready to raise rates in March, and he left the door open to moving at every meeting in 2022, if needed, to curb the fastest US inflation in a generation. Most economists forecast the Fed will make a quarter-point move in March, though Nomura Holdings, Inc. expects a 50 basis point increase, citing Powell's comments. Now, before we leave, just another article published on the 25th of January referring to the Bank of England, and it says Bank of England's silence leaves investors seeing signal for action on rates. So we've already mentioned now that the Fed has come out very hawkish. Well, Bank of England officials have largely decided to keep quiet in the run-up to February's crunch meeting, allowing expectations to solidify for another interest rate increase. Since the bank hiked rates in December, few of the 9-member Monetary Policy Committee, which is the equivalent to the US FOMC, have spoken, and none are scheduled to before their next meeting. That's despite increasing market bets that another increase will come on February the 3rd. The relative silence breaks from the effusive commentary made ahead of the November and December decisions. It also diverges from other central banks around the world, notably the US Federal Reserve, which has stepped up hawkish rhetoric in response to inflation. What we are finding particularly intriguing at the moment is the stark contrast between members of the Bank of England's Monetary Policy Committee and their peers over at the Fed. with the Bank of England contingent conspicuous in their silence. Gary Kirk, a partner at 24 Asset Management, wrote last week. This appears to be deliberate and coordinated by those in Threadneedle Street. The December rate hike marked the Bank of England's first increase since the start of the pandemic, but the decision next week, on the 3rd, is every bit as momentous. Another hike would mark the first back-to-back rate hikes since 2004. It could allow officials to begin paring back their £895 billion or $1.2 trillion of bond holdings in March, the first decrease since quantitative easing started more than a decade ago. This coming week, we highlighted in the weekly update that we have some very important data coming out of the United States. Data that, in fact, will have some influence on Jerome Powell's decision-making over the next month or so. Now, on Tuesday, we have the market manufacturing and the ISM manufacturing indices. But on Wednesday, we have the ADP employment report, which often, not always, but often leads to a guide as to what's likely to happen to the even more important non-farm payroll report on Friday. And that's the one we're all going to be watching very closely. Intermingled between those, we have both the market and the ISM services index. So it's an important week for data. Markets are going to be sensitive now if a Fed president has come out commenting in this way. It's being backed up with one of the larger banks and will no doubt be added to the comments by other major financial institutions. This could cause some traders to keep on buying the dollar and perhaps selling equities. Although there's no guarantee that a strengthening dollar means a weaker precious metals market, it is very likely and does happen in the majority of cases. We shall be watching this situation very closely over the coming days, and obviously if something springs to mind that perhaps is not being covered by the mainstream media, or being covered, shall we say, tentatively, and deserves more attention, rest assured, we will raise that in a video. Thank you so much for listening. Please give us a thumbs up, subscribe, press the bell sign, and if you haven't listened to our update, as mentioned earlier, there is a link below. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.